So, bro, what's up?
Retirement accounts are up.
Yay! That sounds like good news.
It is good news. And we know this because Fidelity has released recently its quarterly analysis of the more than 30 million IRAs, 401ks, and other retirement accounts that investors have with Fidelity. So it's a pretty good survey of what people have and how they're doing. And this latest report is particularly interesting because not only do they provide the most recent numbers as of the end of the first quarter of this year, so March of this year, but they provided the numbers from March from 10 years ago, which was right when the stock market bottomed after the Great Recession. So we not only get to see, we've talked before about how well the stock market has done since then, but this report gives us an idea how much better retirement savers are doing since then. So let's dig into 6 questions about the average retirement saver that this report answers. Number 1, how big is it? And of course, I'm talking about 401k account balances reaching $103,700, an all-time high. It's up 8% since the end of 2018, so that first quarter. And to be honest, I was a little surprised at that. I thought it'd be more because in the first quarter of this year, the S&P 500 was up almost 14%. Plus, people are putting more money into their accounts. But I think the bottom line is, of course, that not everyone is invested completely in the stock market, which is a topic we'll hit on a little later. So how does that $103,700 compared to a decade ago? $46,000 was how much the average person had in their 401k.
Wow, okay.
So it's more than doubled.
Okay.
But again, that's good. But again, you might have expected more given how well the stock market has done. But 401ks are tricky because these averages could include everyone who's been there for 30 years versus and someone who's only been there for 6 months. So they very helpfully broke out the numbers of the account balances based on what generation you're a part of, as well as for numbers for someone who's actually been participating in the same account for a decade. So if you look at someone who's been participating in the same account for a decade, the average balance is $297,000. versus just $52,000 a decade ago.
Okay.
So it's up 466%.
Not too shabby.
Very good. Very impressive. And just in case you're curious, the average balance for someone who's been investing for 10 years, millennials, $129,000, Gen X, $268,000, boomers, $357,000, which is good news, especially when you hear stats about the average amount that someone has, especially at that age as they're about to retire. For those who are participating in a 401k and have been saving, they're doing pretty well. All right, so that's how much people have saved if they're actually saving. But what about question number 2? What percentage of employees are actually participating in a 401k? And the answer to this really depends on whether or not the 401k automatically enrolls people or not. If the plan automatically enrolls you, just once you join the company, you're put in the 401k, 88% of employees participate. If they don't, 52%.
Wow. Big
difference. Clearly, people need a nudge to sign up for the 401k. And we hear about the retirement crisis and how people haven't saved enough. Obviously, one answer is just to make sure everyone gets put into the 401k. Once you're in there, only 9% of people then change their mind and say, no, I don't want to be in there. Once you're put in the 401k, the vast majority of people stay in it.
Well, we're only talking about the people in this country who even have, it's a slice of people who actually have access to a 401k. Think of all the people who don't even have access to a 401k, who have to go through so many more hoops to save money for retirement. It's a huge barrier to entry.
It really is. It's around a little bit more than half of employees are covered by a work plan, 401k,
whether it's a pension or something
like that, right? Which means almost half don't. Now you can still choose an IRA, but IRAs have lower contribution limits. Also, you can set up a solo 401k if you're self-employed, but that's kind of a hassle. So having a job with a work plan is a huge, huge benefit. So one thing also that is higher is that the amount you're automatically enrolled in. So a little less than half are automatically enrolling people at 4% or higher, which means that more than half of the employers are automatically enrolling people at less than 4%, which in my opinion is too low. I think you can get away with automatically enrolling people and having them contribute more than that. If they don't like it, they can always change it. But I think that's also another way to be helpful. So number 3, how much are people saving? So the average employee is deferring 8.8% to their 401k. Employers are putting another average 4.7% for a total of 13.5%. another all-time high, which is pretty good. We've talked before about how I think really people should be shooting for 15%. And that's if you're starting in your 20s, maybe even your 30s. So
Before the match.
No, the match included.
Including the match.
Match
okay.
included. And that's part of what we've done here at the Fool. If you contribute 9, you get 6 for that 15. So people probably should be saving a little bit more, but still, this is pretty good news.
Yeah.
Yeah.
And now I need to go hop into Namely and double check how much I'm contributing to our 401k.
So question number 4, how are they investing? And this gets back to that question of asset allocation, things like that. The report really celebrated the fact that people are more diversified. So for example, they had this stat saying only 10% of the people are either 100% in stocks or 0% in stocks, so all in or all out. Compared to 2009, it was 25% of people who were all in or all out. Now, me personally, I think as a relatively aggressive investor and a typical Motley Fool, I'm actually fine being all stocks. So I'm not sure this is a great thing necessarily to celebrate, especially since stocks have done so well over the last decade. But I do think generally diversification is important. And the reason people are becoming more diverse is the use of target date funds. Target date fund is just a single mutual fund that owns other mutual funds, mix of stocks, bonds, cash, international stocks, U.S. stocks. And currently, 52% of people with a 401k at Fidelity are exclusively invested in a target date fund, compared to just 16% in 2009. And this also goes back to the automatic enrollment, because for plans that automatically enroll employees, 90% of those people are being enrolled in a target date fund. I think it's a great solution, especially for the hands-off investor. But even the most aggressive allocations do have some cash and bonds. So if you are a more aggressive investor, you might want to fiddle with that a little bit.
Yeah, I'm in a target date fund, and I was thinking I need to maybe start contributing to a farther out target date just to maybe get a little bit more aggressive.
Yeah. And it is interesting because we just recently on the 401k committee here at the Fool evaluated our target date funds, and we felt that the ones that we had were too conservative generally, and we've replaced them with another set that are more aggressive generally, but they get really conservative right before retirement, which some people think is good, but it's a debate about exactly what they call the glide path should be. So it is pretty complicated. Again, target date funds I think are generally good, but you do want to make sure you have the right ones. All right, two more things from the report. Number 5, our retiree wannabes choosing the Roth or the traditional. And the answer for 401ks is overwhelmingly the traditional. Almost 90% of people are going with traditional. Only 11% are going with Roth. But interestingly, when you look at IRAs, it's different. With the IRAs, 52% are Roth. So what people are doing is they're using the traditional for the 401k, but then opening a Roth IRA, which I think makes a ton of sense. I did this for many years. You get the tax diversification and having a little bit of both. Also, generally speaking, people are more aggressive in their IRAs because they can buy individual stocks and things like that. And if you want one account to grow the most, it's the Roth IRA because the distributions are tax-free. You want your tax-free account to grow the most. So I thought that was pretty interesting. They also had a stat in here that I already said the average 401k account for $103,000, the average IRA $107,000. But when you look at the average total of people who have both 401ks and IRAs with Fidelity, the total is over $300,000. And I actually sent them a question, like, why is it that the combined is so much higher than the separate? And they said the people with IRAs and 401ks are much more engaged and they save more. They also tend to be a little bit older. But I certainly think it makes a lot of sense that if you have the money to invest in both. And finally, number 6, what made me cry the most? Well, they had a stat on what people do with their 401ks when they leave their job. We've talked about this before. 36% of the people cash out their 401k. They don't roll it over to their next 401k. They don't roll it over to an IRA. They take the money, which means they pay taxes. They pay penalties if they're not 59 and a half, and they miss out on all that future growth. Also makes me sad because I know a lot of people are doing this for reasons they have no choice over. They might have medical bills or something like that, and I certainly have sympathy for that. But please, 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 if you're ever thinking of doing this and you don't need the money, roll it over to an IRA. You're going to save yourself a lot of current bills in terms of taxes and penalties, but you're going to be very grateful you kept that money invested when you retire. And that, Allison, is what's up.